Usually when we talk about a global market sell-off, there's this expectation of a synchronized plunge.
Right. A domino effect.
Exactly. It's like a line of dominoes. One
Yeah.
major market tips over, and you just watch the rest fall in exactly the same direction. It feels clean, predictable.
Yeah, you assume global capital just moves as one giant unified herd.
Right. But then you step into the reality of August 2026,
Yeah.
and suddenly that neat little line of dominoes it's completely broken. We're looking at a financial landscape right now that is honestly completely bifurcated.
It's a massive divergence, yeah.
Hmm.
And we are pulling from two specific financial reports to map this out for you today. We've got the Bajaj AMC monthly market outlook for August 2026 and a really interesting report from Ambit Asset Management titled A New Ascent for Small Caps.
Yeah, those are our core sources for this deep dive.
Right. And our mission today is to cut through all this noise. Because if you've been watching your portfolio lately, you already know the global markets have been experiencing a massive, sobering reality check. But right under the surface, specifically in India, a very different story is quietly brewing.
Okay, let's unpack this. We need to start at the macro level just to understand why money is shifting so dramatically inside India. If we look back at July 2026, we saw a brutal tech sell-off globally. I mean, it was rough.
Oh, absolutely brutal.
Right. South Korea's KOSPI plunged over 22%. The NASDAQ 100 lost 6.6%.
Yeah, it briefly entered correction territory.
Exactly. And the catalyst for all of this, investors just started panic selling AI chips and AI beneficiary stocks. Just a massive flight from that sector.
Which is critical to analyze because, and we need to be clear here, it wasn't a failure of the technology itself.
Right. The tech works.
Exactly. That sell-off was driven by valuation fears, rising Chinese competition, and a sudden, really sharp realization regarding capital expenditure. You have these massive hyperscalers, the tech conglomerates that are literally building the physical data centers and infrastructure for AI.
Spending billions.
Right, unprecedented amounts of capital. But investors suddenly looked at the balance sheets and realized, wait a minute, this historic infrastructure spending isn't instantly translating into tangible bottom line profits.
It makes me think of, okay, imagine a city deciding to build these massive multi-billion-dollar futuristic superhighways.
Okay, I like that analogy.
Right, so they spend years laying in the asphalt, putting up the toll booths, building these massive on-ramps. But then opening day comes and investors are looking out the window, absolutely panicking.
Because there aren't any cars.
Exactly, there aren't any actual cars driving on them yet. The infrastructure is built, the money is spent, but the revenue-generating traffic just hasn't arrived.
What's fascinating here is how the Indian market reacted to that exact global anxiety.
Yeah, this is the divergence part.
Exactly. While the rest of the world's tech sectors were bleeding heavily from that hyperscaler panic, India's Nifty 50 actually stayed in the green. It was up 2.17% in July.
Which is wild when you think about what was happening everywhere else.
It is. But you can't just look at that headline number. If you look beneath the surface, domestic investors in India got highly defensive. They engaged in a massive flight to quality.
The data definitely shows that.
Yeah.
They piled heavily into large caps. I mean, the Nifty Next 50 actually outperformed, and oddly enough, they flooded into domestic IT, which was up a staggering 17.13%.
Right. And at the exact same time, what were they selling?
They were aggressively dumping small caps and banks, like both private institutions and the state-owned public sector banks, the PSUs, just getting rid of them.
Right. But that defensive rotation into large caps in IT is masking something much bigger. It's essentially a smokescreen.
The smokescreen for what?
For a structural opportunity that has been quietly developing over the last 18 months. And it's happening in the exact sector everyone is currently ignoring out of fear, Indian small caps.
Heck, color me intrigued.
Right. To understand why the smart money is quietly looking there, we have to strip away the recent global panic and look at the actual trajectory of small caps over the last 3 years.
Which, to be fair, has been a complete wild ride for anyone invested in it. If you were holding small caps in 2023, you were thrilled. I mean, the nifty small cap 250 delivered massive returns of 48.1%.
Huge numbers.
Yeah, and the momentum carried right into 2024, tacking on another 26.4%. You felt like a genius.
Yeah.
But then came 2025.
Yeah, the reset.
Right, the index dropped 6%, which the Ambit report notes was its weakest calendar year performance in 7 years.
And the why behind that 2025 drop is the entire crux of the argument here. We really have to distinguish between a systemic crisis and a simple valuation reset.
Okay, break that down for us.
Sure, so if you look back at 2018, the small cap market crashed because of the ILNFS credit freeze. That was a shadow banking crisis. Smaller businesses literally couldn't get the cash they needed to operate their day-to-day business.
It was a fundamental breakdown of the system.
Exactly. Or look at 2020. That was an unprecedented global pandemic shutting down physical supply chains. Those were fundamental systemic disruptions to the actual economy.
Right. So
Yeah.
looking at 2025, we didn't have a pandemic. We didn't have a massive credit freeze. This wasn't a systemic failure of Indian businesses.
Right.
The math just got completely ahead of reality.
That is a very precise way to look at it, yeah.
Yeah.
Earnings growth was still happening, but it couldn't mathematically keep pace with the sky-high valuations that the 2023 and 2024 rallies created.
People just got too excited.
Way too excited. Regulators started publicly warning about excessive speculation. They actually started requiring stress testing for small-cap funds just to cool things down.
Wow.
Yeah. And add to that a massive flood of new IPOs and primary issuances, which basically sucked all the available liquidity out of the secondary market.
Okay, so the 2025 small cap drop wasn't a bubble violently bursting. It was more of a pressure release valve.
That's a great way to put it.
It's like letting a bunch of air out of an overinflated tire before you take it on a long road trip. You let the pressure out deliberately so it doesn't pop on the highway at 70 miles an hour.
Exactly. And because this was purely a valuation realignment, not a deterioration of the underlying business models, historical data shows us that the recovery timeline from this specific type of reset is much faster.
Because the businesses themselves are fine.
Exactly. Because of that pressure release, as of July 2026, 47% of small cap stocks are now trading below their 10-year average valuations.
Wait, 47%?
Yep.
That is nearly half the market sitting on sale compared to a decade-long historical average.
And to give you context on how unusual that is, only 27% of large caps are trading below their 10-year averages right now.
Okay, so a huge disparity.
Massive. The excesses, the speculative froth, it's all been completely cleared out of the small cap space.
I hear that, but 47% sounds almost suspiciously high. And frankly, just because a stock is cheap doesn't mean it's a good investment.
Oh, absolutely. Value traps are a real thing.
Exactly. A cheap stock can stay a cheap stock forever if nothing fundamentally changes about the business. It needs a catalyst. And this is where the reports start detailing how two massive external headaches from 2025 have suddenly transformed into massive tailwinds for India in 2026.
Yeah, these are the catalysts that change the entire trajectory. For much of 2025 and early 2026, geopolitical risk premiums were weighing heavily on the global market.
Right, largely centered around tensions in West Asia.
Exactly. But looking at the objective data, and we're just impartially reporting the economic impacts here, the ceasefire framework agreed upon between the United States and Iran in June 2026 formally reopened the Strait of Hormuz.
Right. And the economic impact of that was immediate. Because when you facilitate the removal of restrictions on global maritime trade, especially in that specific region, oil reacts instantly.
Oh, it plummeted.
Yeah. We saw Brent crude prices crash from a peak of $115 a barrel down to around 82.
Which is a huge relief for import-heavy economies.
Exactly. And concurrently, the Indian rupee stabilized and strengthened, recovering to roughly 95.7 against the U.S. dollar.
Yeah.
For an economy like India's that imports a massive amount of its energy, cheaper oil and a stronger currency is a massive systemic relief.
It lowers the foundational cost of doing business across the entire country. But, the trade story is arguably even more impactful.
Oh, the tariff cuts.
Yeah. India scored a massive victory in trade negotiations with the U.S. Again, we are reporting purely on the policy numbers here, but the punitive 50% tariff that was slapped on Indian goods back in August 2025. It's been systematically slashed.
Huge drop.
As of the July 2026 adjustments, that tariff is down to just 10%.
I mean, the competitive implications of a 40% drop in tariffs are staggering. India is now operating on tariff parity with, in some cases even better than, major manufacturing hubs like China and Vietnam.
Right, because they are currently sitting at roughly 12.5% effective tariffs.
Exactly. And it doesn't stop with the U.S. The UK Comprehensive Economic and Trade Agreement, the CETA, went live in July. Plus, there are upcoming U.S. and EU free trade agreements that estimates suggest could boost India's exports by $67 billion annually, starting in calendar year 2027.
All of which fundamentally changes the growth math for Indian businesses going forward.
Here's where it gets really interesting. Why does this matter so much more to small caps? If I'm looking at global free trade deals and massive tariff cuts, my first instinct is that massive, multinational, large cap conglomerates are going to be the ones capturing all that value. Why would a small cap benefit more?
It's a very logical assumption, but if we connect this to the bigger picture, the data tells the exact opposite story. It all comes down to export intensity.
Okay, explain that.
The small cap index actually has a significantly higher exposure to export-heavy, trade-sensitive sectors than the Nifty 50 does.
Yeah, the Ambit report highlights this specifically.
It does. Look at capital goods. Small caps in this sector have a 20 to 35% export intensity.
Wow, that's high.
Yeah, and you see similar high export reliance in auto components and specialty chemicals. Now, consider the operational reality of a smaller company. They operate on razor-thin margins. They simply do not have the massive pricing power or the economies of scale of a large-cap conglomerate.
So they feel every bump in the road.
Exactly. So when a punitive tariff drops from 50% down to 10%, that isn't just a nice little top-line revenue bump for them.
It's a complete transformation of their balance sheet.
It fundamentally alters their profitability. That 40% difference drops straight to the bottom line as pure profit. It gives them immediate capital to reinvest, expand capacity, and accelerate earnings at a rate a massive, mature, large-cap companies simply cannot match. It's a textbook example of operational leverage.
Okay, so the external environment is perfectly set. We've got cheap oil acting as affordable fuel for the economy and slash tariffs clearing the road for exports. But is the engine actually running well?
What do you mean?
Well, you can have cheap fuel and an open highway, but if the factory's machinery is completely broken, you aren't going to produce anything. So let's look under the hood at the domestic fundamentals.
Ah, I see. Well, the internal health of these companies is perhaps the strongest part of the thesis.
Really?
Yeah. Following that valuation trough in mid-2025, the earnings outlook completely turned around. By June 2026, the Nifty Small Cap 250 delivered an estimated 27% year-over-year increase in profit after tax.
27%, that's massive.
It is. They are currently outpacing the large cap segment in pure earnings growth.
And it's not isolated to just a few standout small caps, right? The broader corporate health in India is at historic levels right now. Corporate profit to GDP for listed companies hit an estimated 5.7% in FY26. And if you zoom out and include the unlisted universe, aggregate corporate profits are sitting at roughly 7.9% of GDP. That is significantly above long-term historical averages.
And you know, the most crucial detail is how they are managing those record profits.
Are they just paying it out in dividends?
No. Over the last decade, we've seen a massive deleveraging cycle across Indian businesses. Corporate leverage, which is the net debt-to-equity ratio, is currently sitting at a decade low.
Wow.
Yeah. And small caps historically always carried the highest, most dangerous levels of debt. But they have seen the sharpest reduction in indebtedness since 2016.
So just to be clear, they are making more money than they have in a decade, and they owe less money than they have in a decade.
Precisely. Which means when they generate cash today, it isn't being siphoned off just to service old debt. It goes directly to expansion and modernization.
We are definitely seeing the proof of that in the capital expenditure numbers.
Oh, the CapEx is booming.
Yeah, total listed CapEx grew 9% year over year, hitting 11.5 trillion rupees in FY26. And that investment growth was primarily led by the mid and small cap sectors. They aren't just sitting on the cash, they're actively building for future capacity.
Right, setting themselves up for the next cycle of growth.
So what does this all mean? We have healthy, historically cheap, fast-growing companies that are perfectly positioned for an export boom. But who is actually buying them? Because this brings us to what is easily the most surprising structural shift in this entire deep dive.
The liquidity shield.
Yes, the liquidity shield.
It's a profound systemic shift in how capital moves to the subcontinent. We're talking about the changing face of the Indian investor.
Right. Historically, anyone watching the Indian markets always looked at foreign institutional investors, the FIIs. They were the undisputed kingmakers.
They called the shots.
Exactly. If massive foreign funds bought into India, the market went up. If they got spooked and sold, the market crashed. It was that simple. But right now, domestic money has entirely taken over the steering wheel. The net inflows from everyday Indians into small-cap mutual funds skyrocketed from roughly 10,000 crore rupees in FY22 to nearly 52,000 crore in FY26.
That is more than a five-fold increase in just 4 years. It's staggering.
It really is.
And market depth is recovering right alongside it. Trading volume is back up. The 30-day average traded value for small caps recovered to $12.2 million by June 2026, which fully eclipses the pre-correction levels.
So domestic retail investors, the DIIs, have essentially become a giant impenetrable shock absorber for the Indian market. Think about the mechanics of this for a second. While foreign money is out there panicking over global AI fears and dumping international tech stocks because of hyperscaler capital expenditures.
Right, the AI hangover.
Exactly.
Yeah.
While they're doing that, the everyday Indian investor is just quietly executing their monthly SIPs.
And we should clarify why SIPs, systematic investment plans, are so structurally important here.
Right, right. For those who might not use that specific term, an SIP means a retail investor is automatically transferring a set amount of money from their paycheck into a mutual fund every single month, completely ignoring what the headlines say. It's automated capital.
Automated, relentless capital. They are effectively putting a permanent floor under the small cap market. This raises an important question for you to consider as you look at your own portfolio strategy.
Right.
For decades, foreign capital dictated the fate of Indian equities, especially the volatile small cap segment. But the data unequivocally proves that domestic savings are now the primary driver of capital. The traditional rules of market liquidity in India have fundamentally changed.
It's not just a trend. It's a structural evolution of the market. The resilience of these domestic inflows has completely offset periods of heavy foreign selling. It has created a stable, predictable liquidity environment that simply did not exist during any previous market cycle.
Exactly. And when you combine that automated liquidity with the valuation reset we saw in 2025, you create a very rare, highly compressed market environment.
Let's bring all of this together. We've covered a massive amount of ground today on this deep dive.
We really have.
While the global market was entirely distracted by the bursting of the AI hype bubble, retreating into the perceived safety of large cap stocks, Indian small caps secretly underwent a very healthy, very necessary valuation reset. They let the dangerous pressure out of the tire.
And today, that specific sector is backed by incredibly strong fundamentals. You have slashed trade tariffs making their exports globally competitive overnight. You have cheap oil and a stable currency lowering their operational costs.
Which is massive for their margins.
Huge. Plus, you have corporate debt at a decade low, earnings growth outpacing large caps, and a literal wall of domestic retail money pouring in every single month, setting a hard floor on prices.
They're perfectly positioned for a massive news cycle. But before we wrap up this deep dive, we want to leave you with one final, slightly provocative thought to mull over.
Yeah, this is the really compelling part. We established that domestic mutual funds have created this massive liquidity shield, hoarding small cap assets month after month.
Right.
Meanwhile, foreign institutional investors have been sitting on the sidelines, paralyzed by global tech volatility and largely ignoring the Indian small cap recovery. But what happens when the dust from the AI panic finally settles?
Oh, wow. Yeah.
What happens when those massive foreign funds look at their global asset allocations and realize they are severely underweight on India's most profitable, least leveraged, and currently cheapest sector?
That is the multi-billion-dollar question. If a tidal wave of returning foreign capital suddenly realizes they missed the boat and tries to rush back into Indian small caps, they are going to collide with a market that is already completely dominated by domestic retail money.
A market that's heavily locked up.
Exactly. And that domestic money is holding very tightly to these assets through automated SIPs. Are we looking at a severe supply squeeze? Could that collision of desperate foreign capital and entrenched domestic holding trigger a historic melt-up in small cap valuations? Something you definitely want to be exploring on your own.
It's a scenario that the math and the structural changes strongly support. The superhighway of the Indian small cap sector has been quietly built, the underlying machinery is running flawlessly, and the massive traffic jam of foreign capital is about to arrive all at once.
The cars are finally showing up to the highway. Thank you for joining us for this deep dive. Keep looking past the headlines, keep questioning the consensus, and keep exploring the data.